Opportunities still existing in trading despite the current economic climate being marred by uncertainty. As an example, analysts have highlighted the performance of the JSE as the local bourse reached an all-time high in January. South African equities are also said to be attractively priced. Portfolio Specialist Director at Morningstar Investment Management SA, Debra Slabber, speaks to us about this development. Debra, we saw an impressive run in January recently from the JSE. Let's unpack really what made up a part of those trades and what stands out.
Good morning, Tumisang, and thanks so much for having me. So I think the rebound that we saw in January, in my mind, it was really threefold. So the one reason was really the reopening of the Chinese economy and the optimism around that. The second reason was that inflation seemed to be coming down, and the market started to price in a scenario where central banks across the globe are actually going to start cutting rates, which is a good thing for equity markets. And then I think a third reason was really around Europe. Europe being in a much better position than the market initially anticipated a year ago when the invasion of Ukraine happened and the energy crisis started to unfold. So I think those are really the three reasons that filtered through to our local stock market. And today we know we're not sitting at an all-time high anymore. But even with the all-time high that we saw in January, we think there are compelling opportunities in the local market.
And where are we sitting? Because the economic picture across the globe has changed. Even in the last 3 weeks, we've seen considerable adjustments and challenges that have come through into the market, changing the narrative of where the economy was meant to be going in the first parts of this year.
No, absolutely. And I think if you think about the world today, I mean, every single crisis that could possibly unfold is busy unfolding. And specifically for the local market as well. I mean, we've got slow economic growth. We have interest rate hikes into a weakening economy. We're sitting with high inflation rates. We're sitting with a strong dollar. Mass foreign selling in South Africa. We've been grey listed recently. We're sitting with a power crisis. So you throw everything at this market, and yet South Africa has proved to be so resilient. And I always just remember that the first thing that they teach you in Investing 101 is you buy low and you sell high. And prices are low when news are bad. And at this point, news are incredibly bad out there. So if you ask me about specific opportunities in South Africa, it's actually across the spectrum, from industrials to financials, in particular financials, to resources. So they select opportunities across our market. And if you delve a little bit deeper into that, I think on the global earners in South Africa that actually don't earn a lot of their revenue in South Africa, they're still very attractively priced. Talking specifically like things like British American Tobacco and Anheuser-Busch. So loads of opportunities for clients and investors that are willing to be patient and willing to accept the fact that the economy and the stock market is actually not the same thing.
And that's the key, right? Patience and playing that long game in investing, Debra. And like you rightfully say, that local market activity does not necessarily mirror the economic trajectory in not just only in South Africa, but the rest of the world. How do those two translate? Because that example of the JSE performance in January was definitely quite different from the economic pressures that you and I and the rest of South Africa feel on a daily basis.
No, absolutely. So I think the big difference that we need to distinguish is that the economy is backward looking. So it's around data and things that already happened, and we're reporting on that. Whereas the market is an incredibly good discount of information for forward-looking earnings. So what the market is doing, what the economy is not, it's a forward-looking tool. So it's telling you what do you need to pay today for expected future earnings. So those two very often are not in sync. And that's why sometimes you see stock markets rally when the economic news are quite bad. And I think in South Africa, what we need to realize is that at least the news that's bad is reported. It's visible risks. Everyone knows about it. So me saying that the market's a very good discount of these type of information, we think that these assets are priced for a potential very bad outcome. And sometimes the outcome is not as bad. Then you get these market rallies like we had in January.
We cross fingers that, the near-term outlook is a positive one, and it brings me to my next question about buying cheap and selling higher. What are the prospects then of one somewhat being a little bit guaranteed by whatever investment that they make or within a stock that they buy that you will sell higher?
Yeah, so I think this maybe the answer is twofold. So the one is a lot of the shares in South Africa, you actually don't need that stock price to increase to make money. And I'm saying that because dividend yields today are incredibly attractive. And if you look at a company that I mentioned earlier, British American Tobacco, is trading on a dividend yield of 8%. That is giving you more than what you would earn out of cash. So you don't need, you're basically getting paid to wait for that stock price to go up. So it's kind of magic. So, and then on the other part of this question is, or this answer is that you're never going to be guaranteed to have good returns in stock markets in the shorter term. But over long term, you will not be compensated for taking on for staying in cash. That's just the way that the market works. So you in the shorter term, yes, cash can be fantastic, can be a fantastic tool to asset allocate, but in the long term, you need growth assets in your portfolio to ultimately beat inflation.
And how important does it become then to stay invested in all the market cycles that one may see in a year?
I think that's probably the most important thing. Temperament in the market counts a lot more than intelligence at the end of the day. So if you can ride out the storm, if you can have a portfolio that's well diversified, whether you have only stocks or you have stocks and a level of cash or bonds in there, if you remain with your investment strategy throughout your lifetime, you will be rewarded. And I'll tell you a quick story that I read the other day, or I watched a video of Jeff Bezos and Warren Buffett. And Jeff Bezos was interviewing Warren Buffett, and he said to him, like, explain to a 5-year-old, what is your job? What do you do? And Warren said, I buy low, I sell high, I do this over and over again, and today I'm $100 billion net worth. And Jeff said, this is the easiest thing in the world. So why does everyone not do that? You are one of the richest people alive. You've made your money over time. Why does everyone not buy low, sell high, and stay invested? And Warren's answer was actually quite profound. And he said, you know what, Jeff? It is because no one likes to get rich slowly. And I think that's the trick. So we all have to accept that we're not all going to be Jeff Bezoses of the world, but we can be Warren Buffett, and we can save diligently. We can invest through market cycles, and remember that temperament is a lot more important than intelligence.
Thank you so much for your insights. Debra Slabber is with Morningstar Investment Management today, talking to us about investing even in uncertain times where trading is concerned.